This video is over external financing. I'm your professor, Dr. Stephen Haggard. Firms need cash for operations and for investments, and that cash tends to come from two places. Let's call the big categories internal financing and external financing. Internal financing is actually pretty simple. This is money that the firm has earned but has not yet distributed to the shareholders as a dividend. Accountants would refer to this as retained earnings. The other category is much broader. External financing can refer to the issue of stock, the issue of bonds, and the borrowing of cash from banks, as well as other assorted external sources of finance. The question of when firms turn from internal financing to external financing has been asked quite a bit, and we still don't have a perfect answer for it. However, we do know this. Firms that are growing faster than their internal financing can create the assets to grow. Those firms must reach for what is called external financing, and that's what this lecture is all about. In fact, we focus in this lecture on debt financing, but I want to take a moment to talk about equity. According to something called the pecking order theory, firms will choose to issue stock absolutely last because of the bad signal that it sends. What does the signal that issuing stock send? It says that we think our stock is worth less than the current market value, so it makes sense for us to sell it at this inflated value and use those funds. Whereas repurchasing stock says we think our stock is undervalued and it makes perfect sense for us to purchase that back with cash from the firm because that stock is actually worth more. And so external financing from stock is not what we would consider our first option. So a lot of external financing is focused on the concept of debt. What is debt? Debt is a fixed repayment scheme where we borrow a certain amount of money in exchange for promising a fixed set of payments. And the two broad categories we'll talk about here are bank loans and bonds. And how do bonds and bank loans differ? Well, you can think of bonds as an arm's length transaction. The bond purchasers, who are the lenders, really don't know any more about the firm than their publicly available information tells us. But banks have a more intimate relationship with their borrowers. You can tell your banker a secret that you would not share with your potential bondholders in a prospectus. And so this leads us to think that maybe banks are special and have a special relationship with their borrowers compared to the issuers of bonds or to the bondholders. And so we've got this whole stream of literature now that is focused on examining what are the differences between bonds and bank loans, and then breaking down within bank loans, well, what's important. And that's what this video is all about. So what are the big questions we're trying to answer in this lesson? The first one is, do bank loans send a different signal than bond issuances? As we mentioned, there is cause to think that a bank loan might be different because bankers have a more intimate relationship with their borrowers than do bondholders. And so a bank loan might send a different signal to the market than the mere issuance of bonds. The second question is, do renewed bank loans send a different message than new bank loans? We might think that a new bank loan would be great news because this is the first time that a certain bank has decided to loan to the borrower. But there might be additional information in a renewed bank loan because of the bank's historical relationship with the borrower. Then we ask if bank loans send a stronger signal for healthy firms or for ailing firms. You might think that it would be a good signal for a healthy firm because the firm is growing and the bank is certifying that this growth is real, and therefore this might be a strong signal for healthy firms. But it might be an even stronger signal for a sick or dying firm, or at least a firm that the market thinks is sick or dying, because now someone who has access to inside information has shown confidence in the firm, confidence in the form of extending them a loan. And then finally, do loans from high-quality lenders send a different signal than loans from low-quality lenders? Is it really important that the loan be from a bank, or could a different kind of lender be a good signal to the market even if they weren't a bank, as long as they were considered high quality? The papers for this unit all rely on something called an event study. An event study is simply where we look at the market reaction to an announcement in the days surrounding the announcement. Usually the window is something like the day before the announcement, the day of the announcement, and the day after the announcement. And the reason we look at more than just one day is sometimes these announcements are made after market close, and so the reaction would not be seen until the following day. And sometimes the information leaks out a little bit beforehand, and so you'll see some movement on the day before the announcement. And so in order to capture this, we usually don't just look at one day, we look at 2 or 3. And the first study in this unit is James 1987. And what James does is look at a bunch of different borrowings. And these borrowings fall basically into 3 categories: loans from banks, issues of straight debt, and private placements of debt. Now there are a couple of things there that you may not be familiar with, so let's talk about straight debt. This would just be an ordinary bond issue. In other words, these are not convertible bonds, they don't have any warrants or anything weird attached to them. They're just simply a promise to pay a series of coupons followed by a face value. A private placement is debt that is sold directly to a huge investor, usually an insurance company. And private placements are popular because you don't have to go to the public market to do so. So the transactions costs for doing a private placement of debt may be lower. And what James finds is that there is a positive and significant market reaction to the announcement of new bank loans, but he doesn't see that sort of announcement reaction to private placements or issues of straight debt. And James says that this is evidence that banks are special or unique among lenders. Lummer and McConnell in 1989 follow up, and what they do is look at the difference between new bank loans and renewals of credit agreements. And what they find is that new bank loans elicit very little response from the market, that the positive response James 1987 finds is primarily due to the response to revised credit agreements. And what they say is this means that banks apparently don't have some sort of special ability to see through new borrowers and use their special privileged information to make good loans. Instead, the real value with bank lending relationships comes from the history of the bank and the company together. And so it is the renewal or revision of a credit agreement that is important, not the initial announcement of a credit agreement. And they find that positive revisions of terms, in other words, extension of maturity, lowering of interest rate, removal of protective covenants, these sorts of things are all greeted positively by the market. What this means is the bank has learned things about the borrower that has allowed them to loosen the terms for their second or third round. However, they also find that any sort of tightening of the terms, meaning shorter time to maturity, higher interest rate, or increased covenants, is taken as a negative signal by the market. Why? Because the bank has learned negative information about the borrower during their time together and is now revising credit terms accordingly. So this lets us know that perhaps banks don't have some sort of special skill to be able to see through firms the first time around. It's the repeated interaction that brings the extra information to the market. And the last paper for this unit is Billett, Flannery, and Garfinkel, 1995. They examine not only banks, but also non-bank lenders like finance companies. Now let's talk about the difference between bank lenders and non-bank lenders. Banks are defined as institutions that fund at least a portion of their lending through accepting demand deposits. And so these would be people who are providing checking accounts and savings accounts and things like that. Non-bank lenders get their funds elsewhere. And so what we see is that these folks are not going to be accepting deposits, and they're not going to be involved with the Federal Deposit Insurance Corporation or anything like that. And so they break them into those groups, and they examine whether there's any difference in market reaction to loans from these folks based not on their identity, but on the quality of the lender. Now they have to have some sort of measure of quality, and what they are using is the lender's credit rating as issued by S&P 500 or S&P or Moody's. And what they find is that higher quality lenders elicit greater market responses, more positive market responses when they make a loan to a company, and lower quality lenders elicit a lower market response when they announce a loan to a company. And so it's not the identity, bank or non-bank, that matters, it's the quality of the lender. And in fact, they liken this to the underwriter reputation effect identified by Carter and Monastir in 1990, in which the more reputable underwriter leads to lower IPO underpricing.